I'm Dan Passarelli of MarketTaker.com here on the floor of the CME Group. Well, one of the trades we talked about today in our group coaching class was in FXI. And that, of course, is the big China ETF, a way to get in on the Chinese market. Well, take a look at a chart of the China ETF, and it looks like we might be able to play a somewhat neutral strategy, but only if we can trade it with an advantage that gives us enough room to be a little bit wrong. So the best way to do this in this particular situation is with a time spread. Now, the reason why time spreads can be so effective in a situation like this FXI trade is because in this case, there's what's known as a term structure of volatility skew. There's a pretty big disparity between the short-term options implied volatility and the long-term options implied volatility. Now, what we would do with this trade is sell the December 5th expiration 40 strike calls, and at the same time buy the regular January expiration 40 strike calls. So there's a lot of different weeklies expirations that fall between those 2 months, first of all, which we'll discuss in just a minute. But the most important thing is that we can sell those December 5th expiration options at a very, very high implied volatility. That means options are very expensive. And we can buy the January options at a pretty low volatility. So basically what we're doing is we're buying low and selling high at the same time. This gives us a tremendous statistical advantage here. If the stock stays pretty close to $40 a share, the trade's a winner. As time passes, the trade profits a little bit each day because of theta, time decay. Time decay in this case is higher than it should be because of this term structure of volatility disparity we're seeing. The third benefit to this trade is if implied volatility of the short-term options falls in the short term, well, this trade will profit for us as well. So you've basically got three things going for us here on this trade. One, a neutral trade. Two, time decay in our favor. And three, implied volatility, a potential implied volatility crush working for us as well. Now, let's get back to that idea that we have several different expiration weeks between the December 5th expiration that we're selling and the regular January expiration we're selling. If FXI stays pretty close to $40 a share and is trading there come Friday when these options are about to expire, well, what we can do is we can roll to the next week and continue that trade. Basically, we would just buy those December 5th expiration options back for, oh, say, a nickel or something, and then we would sell the next month, which would be the December 12th expiration. Excuse me, I meant to say the next serial weekly options, the December 12th expiration options, and we sell them. And then when those get close to expiring, we can just do it over and over and over again as long as the stock stays close to $40 a share. This is Dan Passarelli here on the floor of the CME Group. Trade well.